Guys, 5 stocks we're going to look at right now. Let's see if any of them are a buy. Stock number 1, Qualcomm. This is a very exciting stock. $142 a share, not close to its all-time high. The all-time high was January 5th, 2022. So a little over 2 years ago, it was $194 a share. 52-week low of 101. Now, this is a $159 billion market cap business and a enterprise value of 176. This difference here is debt. Not bad. $17 billion in actually net debt with $9.9 billion in free cash flow. So reasonably low debt levels. And one thing I also like is 1 year free cash flow is higher than the 1 year net income. 5 year free cash flow is within 5% of the 5 year net income. So it shows that it's hard when companies have very different free cash flow to net income. You always want to see a higher free cash flow than anything or very close to net income. If it's very different, you have to ask the question, why are the free cash flow and net income so different? Solid margins. Look at this, Mo. 55% gross margin, 21% in the last year on profit margin, 24% over the last 5 years. So their last 1 year of profit. Yeah, the last 1 year of profit margin, though, is lower. So understanding that's important. And it seems like a pretty reasonable PE of 20 and price to free cash flow of 16. Now, this is a big company with a high return on invested capital. Look at this 5 year return on invested capital, 32%. Guys,
that's very big.
That's very big. They get a high return on the money invested in the business. This has moat type status for it. You want to pay a premium when the return on invested capital is so high for long periods of time. So the question is a 20 PE too high to pay? Maybe not. That price, that return on invested capital is very solid. Let's take a quick gander at their 8 pillars. Oh, 8-pillar thriller. Look at this. All check marks. Now remember, guys, that doesn't mean you go out and buy. It just means that this story seems pretty solid here. Buying back a few shares, revenue growth increased, net income growth huge, cash flow growth huge. These are all pluses. Again, it doesn't mean go out there and hit that buy button. I've ignored 8-pillar stocks and I've bought 8 red checkmark stocks. It all depends on what the story tells you here. All right. So what are analysts saying, Mo?
Let's see here. Pretty good growth over the next 3 or 4 years, going from $9.35 to $12.44. Revenue side, $38.3 billion to $45.6 billion. Decent growth.
Now remember, because of their good gross margin, that's how smaller revenue increases of mid-single digits can lead to such big earnings per share growth. That's why we like higher margin businesses, because they can grow revenues a little bit, but really increase that profit a lot. So it's not just about having a high return on invested capital that matters. If you have a high gross margin, you can really drive that down. All right. So the stock seems pretty interesting. Let's go look at stock number 2 before we do our stock analyzer tool at the end. Stock number 2, Cisco. Thong Song was a great song. Now, guys, one thing I want to show you guys about Cisco. This is our max chart on Cisco. Look at this big bubble right here. Year 2000. Cisco was, hey, this is going to be the first $1 trillion company, all-time high. March 27, 2000. Not 2020. Not 2021, 2000. Now, you might be thinking to yourself, oh yeah, okay, but the company is dying. Well, last 12 months, they did $58 billion in revenue and $13.6 billion in profit. What did they do in the year 2000?
And you know what's funny?
What's that?
I'm looking at the stock price, $82 a share back in 2000. The highest they got during 2021 was $64 a share intraday.
Still 20% lower than its all-time high.
Yep.
Guys, in 2000, it did $21.5 billion in revenue and profit of $3 billion. So profit is up by 4 times and the stock still hasn't seen that high. Why? Because valuations were insane here. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. That's what I want everybody to remember. This AI hype, the electric vehicle hype, all these hypes that come out that cause parabolic rises in stocks, eventually something happens. I am very confident that we're going to look back 20 years from now and some of the Magnificent Seven will not have hit the highs they hit today because of valuation. So let's go check out some of the pillars. Solid return on invested capital. Over 17% consistent. If you look at their 5 years, it's 17.2. 1 year, 17.6. You've got great gross margin here, 63.7%. So remember, every extra dollar they add in revenue is going to really drive that profit. And the bottom line profit, very consistent. Now, look at what I love, Mo. Look at these. Free cash flow was $17.5 billion last year, $15 billion over the last 5-year average. And look at their net income, $13.5 versus 11.6. So their free cash flow is significantly higher than their net income. And they're only selling for 11.5 times free cash flow. And for all you dividend lovers out there, they pay a 3.1% dividend, pays out $6.3 billion. Guys, do me a favor. If you work at Cisco, I want you to do me a favor. I want you to cancel that stupid effing dividend and just buy back your shares. Right, Mo?
Yeah, absolutely. Now, I will give them credit. It's a very affordable dividend for them. You see a lot of these companies that pay out the majority.
I don't care.
I know, but at least they're not paying like a 6% dividend.
I give you that, but I look at this saying this is an absolute waste of investor capital. You have cheap shares selling for 11.5 times price to free cash flow. Spend that $6 billion over the next 10 years. You can buy back 30% of the company if the stock goes nowhere. You can give the investors who've stayed with you such a good handle on their money. Guys, I don't own Cisco, but it looks pretty interesting to me. Now let's see. One thing I want to look at is how have their acquisitions gone? Have they grown without acquisitions? So we go to the cash flow statement, and right there under cash flow over investing, there's acquisitions and dispositions. Negative $1 billion, negative 6.5, negative $1 billion, negative 4, negative 4. So they have added quite a few. They've spent $21 or $22 billion in acquisitions. They haven't eaten up a ton of their free cash flow making acquisitions, which is good. Yeah. But is this a company that might be poised for some growth? Let's look at their 8 pillars here. Another 8-pillar stock.
Another 8-pillar, yep.
They've bought back only 4.5% of their shares. Shame on you, Cisco. Shame on you.
Should be 40%.
Yeah, buy back your shares. Oh, gosh. Cash flow growth and net income growth are very similar, which is great. Very low debt compared to free cash flow, which is great. Guys, this is an interesting company. I'm really excited to do the stock analyzer tool on this one. Analyst estimates. I want to do that real quick.
It's not a lot of growth.
No, it's not. Single digit. Even revenue side. Yeah, it's not very sexy. So for me, guys, and we'll do this in the stock analyzer tool, for me, you really got to get a good return with lack of growth. Get yourself a little bit more return.
Even more reason for them to buy back shares.
Thank you, Mo. Stock number 3, Lockheed Martin.
All right, defense. It's been in the news lately.
$103 billion market cap. Mo, look at this. $147 billion, $148 billion enterprise value. So a little bit more. Guys, this is a contractor for the federal government. I mean, look at their free cash flow and net income over the last year, over the last 5 years. Very, very consistent. So where's the growth coming? Look at this gross margin, Mo, 12.5% with a bottom line of 10, which means they basically just like cover all their costs in these contracts. My personal opinion, even though they have a high return on invested capital, I don't like government contract businesses. Let's look at the 8 pillars, another 8 pillars company. Okay, they're buying back shares. The debt level is a little bit on the higher side, but again, it's a government business where everybody high up in the government has friends who work there, so they're trying to pad their pockets. Price to free cash flow of 16, PE of 16. Our in-house analyst here, Dalton, just used to work for a government contractor. Dalton was in charge of building nuclear weapons. Am I wrong? No, I'm just kidding. He was not in charge of that. Yeah, he told us he had to kill us. That's right.
Look at the analyst estimates.
Oh, my
Way,
Lordy.
way lower than I expected.
Oh, my gosh.
Yeah.
So revenue growth of low single digits, but yet profit of nothing. Basically, profit staying the same, according to analysts, over the next 3 years. Okay, let's go look at stock number 4. Williams-Sonoma. $12.75 billion market cap, $15 billion enterprise value. Guys, 10 price to free cash flow. With higher price to free cash flow than net income. This is retail, 41% gross margin with a bottom line of over 10%, 11 and 12. So, okay, pretty good stuff. Look at this return on invested capital, Mo. 27.5% over the last 5 years, 30% over the last year. A dividend of $226 million, 1.8%. Williams-Sonoma, do us all a favor, cancel that dividend, buy back those shares. You can buy back 2% of the company every year. and not give your investors a tax bill. Guys, for those of you who love dividends, I think dividends are the last thing a company should do with their capital. Last thing. If they have cheap shares, like it appears Sonoma does, buy back your shares. Reward your investors that way. But of course, nobody thinks that way. And that's why I'm an idiot on camera. All right, let's go check out the 8 pillars of this company. 8-pillar thriller. Oh, they have bought back some shares. Look at this.
It's actually a pretty good number.
Yeah, 17.7%. Wow, net income growth. Look at this. That's what I love, Mo. 5-year net income growth of $600 million. 5-year cash flow growth of $900 million. Mm-hmm. That's wonderful, guys. And a lower price of free. Listen, I like this. The question is, before you go look at this company, is how are they competing in the online world? Are they going to be like everybody else and just poop the bed? Let's look at their income numbers. Okay, so revenue is down over the last year. They had big growth through last year, and now it's down. So one thing I want to look at is, let's go look at it right now. Let's look at their same store sales. So I'm going to pull up their annual reports from our main page. I'm going to go to the 10K. They have a quarterly report here. Let's see what the quarterly report says about comparable store sales. All right, guys, so I tried it, and it's not showing me comparable store sales, which kind of bothers me. But there are some other things we can look at to look at revenue. Every company looks like every bit of them looks like it's down year over year from the quarter. I don't like that very much. Is that a sign of the consumer? Is that a sign of the company? Store count? They have decreased the number of stores they have by 1 net. Nope, they increased by 1 net. Those are things to look at. With more retail locations, are they opening and closing more profitable locations? That's less profitable locations that they're closing, opening up newer, more profitable locations. That's a way in which they can keep their store count the right levels while still increasing profitability. So that's very, very important. I don't like the fact that they're not reporting comparable store sales. So let's go to analyst estimates. Oh, wow. I'm actually surprised by this.
Yeah, me too.
They're expecting growth in EPS. So they can keep buying back those shares, drive up EPS, and with revenue growth too, Mo.
I'm actually quite surprised.
Yeah, mark me shocked here. Interesting. All right, last company, H&R Block, HRB. This is a company that I owned for a while. It skyrocketed, and then I sold it in the mid to high 30s. So I didn't get the full growth of it. This is a company, guys, where people are doing more and more online with their taxes. So to go into H&R Block, and we're going to look at our income statement here to see how the revenue is going. I am surprised that we actually still see increases here. Decreases, then increases, and still growing on increases. I'm actually very surprised by this. Let's see their profit numbers. Oh, wow. Big jump in profit and holding steady. Interesting. Let's look at the 8 pillars.
See them in Walmarts everywhere.
Are they in Walmarts everywhere, really?
Mm-hmm. Yeah.
Buying back a ton of shares. And as that they should. You know why? Their price to free cash flow is 9. Their PE is 12. Dividend yield. Come on, guys. Guys, your company is a $6.7 billion company. And you have a lot of debt. Look at the enterprise value is 9.15. That's 50% more for debt. That's a lot. To me, pay down, get rid of this dividend, buy back shares, pay down debt. Look at this return on invested capital. This is a skewed number, I'm sure. Yeah, but it's got to be a skewed number.
Has to be.
I mean, look at this. Look at this 5-year long-term liabilities divided by 5-year free cash flow, 3.9. A little bit higher for a company that might have a tough time growing its sales. So guys, what we're going to do now is we're going to go through, we're going to hammer out these 5 stocks in our stock analyzer tool to determine some sort of price to pay for them. Again, don't just buy them if they're green. You have to do more research. All right, guys, so the stock analyzer tool, a few things I want to let you guys know ahead of time. We're doing a 10-year analysis, and I'm doing my returns based on 9% across the board, which means there's no margin of safety, in my opinion, in that. So anytime you see a stock price that it comes to, you have to discount that for your appropriate margin of safety, or you can put it in the stock analyzer tool yourself. Higher desired return means more margin of safety. Here's Qualcomm. I just did some very basic 369% revenue growth, some standard profit margins. I hit the analyze button. Again, no margin of safety. I have a low price of 94, high price of 225, a middle price of 146. So if you pay today's price and the middle assumptions occur, you'll make about 9.5%, including the dividends. Mo, why don't you take over on Cisco?
So Cisco, I have 3, 6, and 9% for revenue growth, profit margin 20, 22, 24, and you can see their free cash flow margin is higher historically. So I went 28, 31, 34. PEs and price to free cash flow 14, 16, and 18, and again, no margin of safety here, 9% returns. 42 to 58 on the low end, 92 to 130 on the high end, middle ground, I'll call it $75.
So it might be appropriate because if you have middle ground of 75 and you believe that, 45 for 50 seems like a pretty decent margin of safety.
I do think so. I'm actually going to move my watch list price.
Okay, guys, so Lockheed Martin, I did 2, 4, and 6% revenue growth. I did a lower profit margin and free cash flow margin. I did 12, 14, 16 PE and price of free cash flow. Really quick, my bias is showing up here. I am putting lower multiples because I do not want to own this company. A lot of people would sit there and say, listen, I understand government contractors. I'm okay paying a premium for them because I think they're great. And desired annual return, 9%. Hit the analyze button. The stock's currently at 420. I have a low price of 280, high price of 495, middle price of 372. Again, assuming no margin of safety. And again, my bias showing up. Stock number 3, Williams Sonoma. I did revenue growth here, even though it's kind of been sucking lately. I did 2, 3, and 5. I did very low what I thought was profit margin. I based on their 10-year numbers, even though their last 5-year numbers have been a lot better. So I might be being a little too conservative here. I did PEs and price of free cash flows, 10, 13, 16. You might argue that's still low. I did it because it's retail. So you might argue, Paul, I think you're being too conservative on the profit margin and PE. And I did desired annual return of 9%. Hit the analyze button. I have a low price of 110 to 120, a high price of 215 to 240, a middle price of 150 to 160. Again, it could be low, but I'm fine with that based on this kind of company. Final company, H&R Block. And guys, one thing Dalton said in our little break, H&R Block, tax code is getting more and more complicated. So there's a lot of value to be given for a company like H&R Block that can sit there and guarantee you an accurate return, or they pay for it. They give you your return. There's a lot of benefits to H&R Block for a lot of people. The question is, can they transition that into more revenue? I did 0, 2, and 4% on the revenue growth side. I did 13, 14, and 15 on profit margin. Free cash flow, I actually kept it the same, even though the last 5 years, the free cash flow has been higher. And I did a much lower PE because of a lack of growth at 10, 12 and a half, and 15. So I hit the analyze button. Stock's at 46 currently. Well, 31 on the low side, 59 on the high side, 43 in the middle. I was fine selling it. And again, guys, if you want to be able to take advantage of this software, our stock analyzer tool, to analyze your own companies, free 7-day trial at everythingmoney.com. Go sign up. Again, 7-day full access free trial, community, all the tools. Thank you very much for your time.